Okay, now we're recording. There we go. And just like that, we're started.
Perfect.
What did you bring to drink?
My regular half calf.
Half calf. So you don't get the shakes?
I definitely get the shakes. My plan of attack is decaf in the morning, and then caffeine as needed. But this half calf will be just enough to get me going and get me excited.
What's the latest in the day you'll drink caffeine?
You know, I had one 5:00 last night.
Did you fall asleep?
No, I didn't fall asleep. So
that's why you look so terrible.
The answer is I've been drinking it too late. No, the goal is to keep. My goal is 0 caffeine. But we all have goals, right? It's like I want to work out every day. It just doesn't exist. It's not how it works.
Yeah.
So I'm working towards it.
Okay, so Little Oak Weekly. Welcome, everybody. You are not Justin Hawks. You are Todd Bohn. In order to everybody, Todd Bohn, say hi. Say hi. Todd is a commercial agent in our office, and he's jumping in with me today to talk all things commercial, which I'm very much looking forward to. We've known each other for how long have you been in the business?
A little over 15 years.
And we've probably known each other for 20-ish years, something like that.
Yeah.
You started at, was it NAI that you started at?
Yeah, I started very briefly at NAI Commercial out of the Langley office.
Yeah.
Actually for maybe a year or two.
Yeah.
And then branched off from there and started, Frontline was a boutique brokerage that was just kind of starting up at that time. It was just getting going. And they'd approached me and asked to come join them and start in the retail and office division. That was primarily in Surrey. So that was about 13 or 14 years ago. And I'd spent a fair bit of time at Frontline and then recently have come to join Royal LePage, and happy to be here.
You guys dominated you dominated what, Surrey, Langley, the entire market, or what's specifically what, and Abbotsford too. I shouldn't say just Langley, Surrey, but you owned a number of segments of that market. Yeah.
Frontline was born out of the energy where, again, we picture where we were 15 years ago. It was the downtown brokerages, Colliers, Cushman, DTZ, and CBRE hadn't really spent a bunch of time expanding, or so they hadn't really successfully expanded into the Fraser Valley. And so 15 years ago, it was seen as this massive growth area. And we started a boutique brokerage really focusing on bringing that downtown feel and level of service, but being based in the Valley. And so we set up our office in Langley, really, really focused on business from Delta to Chilliwack.
Yeah.
And one thing that was really helpful in that time, and I'm grateful we did that, is I made a rule to just say that we are rather be experts in our sandbox than know a little bit about everything. So, and still to this day, if there's properties that would come up and we would want to have commercial discussions about downtown Vancouver or Richmond or North Van or West Van, I would just simply say, I'm not the expert at that, point people in the right direction. But absolutely, Delta Chilliwack is my bread and butter, and have been working that area for 15 years. And Frontline was really well received at that time.
Yeah.
Coming and sliding into the market, being able to give high experience with really good service, and being local, being boots on the ground, really, really made a difference in those last 15 years.
It's totally different. The way the downtown, my observation anyway, the way the downtown brokerage functions versus how successful Fraser Valley agents function. It's like two totally different animals, correct?
Yeah. Certainly they're different worlds. I mean, a lot of the same tools are used, but absolutely, I think different buyers and sellers. And it really depends what scale we're starting to talk about and what asset class too, when we get into industrial versus office and retail. I really do. That's one of the things that commercial real estate gets grouped into one category. Yeah. What's happening in commercial?
Yeah. And
the asset classes are what's going on in residential development land today compared to what's going on in industrial, and then office in the suburbs is different than what's going on in the office market right in downtown Vancouver. So, different asset classes certainly have more variation of what's going on than just to say, here's what's going on in commercial.
So when a residential agent gets into the industry, I grouped myself into this many years ago, like you don't quite know what you're getting into, but you have this like picture of what life is going to look like if you're successful. And it's like, whatever, selling however many homes a year, but it's based heavily around relationships with people that are probably in your life, are going to be in your life as you expand your relationships. When a person gets into commercial real estate, or even not even brand new, but like as you grow in it, what's the picture that an agent has in their brain? Is it all the same or is it different? Like, what is success? What is a person, are you like working with Starbucks and wanting to have Starbucks all over the place? Or what do people think of when they get into it?
Yeah. What a great question. And what a great question for even to ask now, right?
Yeah,
Forget getting into the business.
Yeah,
like, who am I again?
Yeah, exactly.
Who do I service? And
well, let me see. Nothing's selling. So
can I jump to a new asset class? Yeah, I think that one of the major things that we need to just acknowledge right from the beginning is that, and we've talked about this before when we're talking about buyer profiles, but in residential, one of the things I'm jealous about is that every kind of social interaction that you have is a potential client. Right?
Yes,
like
totally.
Majority
100%
own homes, whether you're at the gym, you're at school, you're playing softball, you're with your kids, like your social interactions are also your business it's the same worlds kind of combining, right? Is that fair to say?
100%. In fact, that is, we talk, I often get caught using the terminology revenue streams. Like, one of the things that I try to teach, hopefully well, is that all of these things are potential revenue streams within a residential business.
Right.
Whether you're on a PAC committee at your kid's high school, or you're coaching your kid's softball, or you're involved in a community organization, whatever, 100%. And in fact, that's it. And if you don't leverage those things, then you probably really struggle to find relationships to transact with, because where else are they going to come from? So how does that, then what does that mean? And what does that translate to in commercial?
Yeah. So I would say very different in the sense that, I say that in residential, everyone you interact with is a buyer or a seller at a certain price.
They're all going to own a residential property. They're not all going to own or lease or whatever, a commercial asset.
Right. And even most people, when we talk about, or when they're buying a property on the residential side, if you're priced incorrectly, if you adjust that price by what percent, then do you usually find that market that's willing to buy? Like, when you make a price reduction, what's a big price reduction in terms of?
Yeah. Like, I mean, assuming something's not crazy overpriced, I mean, generally speaking, like a 5% price adjustment can very often make a difference.
Right. So I would say the difference is that there's always a large pool of buyers ready to pull the trigger and buy at any given time. So if the list price isn't the right price, when you make a price adjustment with residential,
you find them.
You find them. The people then show up, right?
Yeah.
They're there and they're like, oh boy, they are real buyers. The difference with commercial is the buyer pool is much, much smaller. So much fewer transactions per asset class. Also, much fewer amount of people looking for product.
Yeah.
And fewer in general. I'm going back to the relationships that we have, right?
Yeah.
So in general, the mode, when you're going back to the difference between downtown and Fraser Valley shops, downtown shops are often made up of really diving into the developers, diving in and really spending a lot of time cold calling, just trying to find people that are interested in a transaction. It's hard. You have to find the people who are interested before you even begin to have a discussion of whether there's value or not.
Yeah.
So, that is the way that we work in the Fraser Valley. The way that I've been successful and fortunate in my career is really building those long-term relationships with business owners. So I think that we have to be much more intentional on the commercial side about interacting, finding time and energy to interact with those business owners. Because the reality is, if you're interacting in your regular life, the revenue stream is only going to come from those people who are in commercial, either owning a business or tenants, and they're much fewer. So you have to be much more intentional about building those relationships. And frankly, it's harder work. It's hard to find the people and stay engaged and give them a reason to be engaged.
You and I worked on something recently, which it was eye-opening for me. I mean, we've talked about it in theory, but until you see a live deal, you don't quite, because I spend all of my time in residential, and then you see something in real life and you go like, oh, wow, that's significant. What I'm referencing is the difference in lending So if somebody wants to buy something for their business,
Mm-hmm.
the way the bank will look at financing an individual when they're utilizing the cash flow of their business versus an individual says, I just want to go and buy this investment property right now. And now what's being analyzed is just the financial performance of that asset. Am I framing that properly?
Yeah.
So what has shifted? Like there's obviously been a significant shift, but we worked on a live situation that didn't come to fruition. And it was because the difference in the bank's position looking at the client going, well, if you're moving your business there, we like it.
Right.
If you're just buying this building that has this tenant, totally changes the conversation in terms of, now we're going to look harder at the cash flow. We're going to require more money up front. There's always been a difference, but how has that changed significantly with a shift in lending policies in the last 2 years?
Yeah.
Is that a fair question? That's a broad question.
Yeah. Well, I think what would be maybe smart is like, we haven't explored this together. Well, why don't we use the example of like, what would a residential home, whether it's vacant or if it's leased out?
Yeah. So if we take a vacant home or a leased out home, doesn't matter.
What's worth more right now?
So if somebody, So if somebody wants to buy rental property right now in a residential world and get residential lending, the bank is going to take what's deemed to be market rent, whether it's tenanted or not. They're going to look at an existing tenancy if there's cash flow, but even if there isn't a tenancy, they will still utilize market rent on the asset. And then the down payment requirements are going to vary depending on the buyer. So obviously if the buyer isn't in a strong financial position, then it's going to be more difficult than if the buyer is. But generally speaking, if a buyer has the capacity to put up, let's say we're talking about something that's sub million, not over a million, 20 to 25 points down. And then the cash flow is going to offset the market rent will offset the monthly carrying costs. And then, what's common in residential space is that the rental money does not offset the total cost to carry the property. However, if the client has the financial strength to make up that shortfall, then the bank lends on it. Right. So like if there's a shortfall by like, let's say $1,000 a month, but the client doesn't care, really wants to buy the property because values have decreased, they'll look at the financial strength of the client and just factor that into all of their total debt servicing and what they're capable of and either approve or not approve. And I would say, it's as basic as that. And then in most situations where clients are financially solid and prepared for that, they get approved. Now, people's appetite to buy an investment property in the residential space maybe isn't as high, knowing that they're going to be eating something financially on a month-to-month basis. But if they look at the asset and say, well, it used to be worth 800 and I'm buying it today at 625, they go, okay, well, I'll take the short-term cash flow pain because I'm buying at the lower end of the market. And, but the approval is entirely based on the financial strength of the client combined with the potential revenue of the property, whether it's leased or not. If it's vacant, it could be vacant and you still get to use market rent in that conversation.
Okay. And what's the demand if you have a house for, maybe now's not the best time to ask this question, but if you have a house for sale and there's 10 interested buyers, of those 10 buyers, how many typically would be looking to occupy the home themselves, and how many would be
today? It's like, the investment market is not totally gone, but it's been decimated
because the property doesn't cash flow and not people don't want to put extra money.
It's not even totally that, because if you go back to 21 and 22 and, things were ripping and it was sexy to buy real estate and everyone was jumping on, there was people buying properties all over the place where it was a little bit speculative, but people would buy investment properties where they were barely break even or not even quite break even. They would go like, oh, I'm only losing $100 or $200 a month, but I want to do this because we're all sheep, right? People just act and do things when the herd is doing it. Even though from a financial analysis perspective, you could look back at it and say, well, that was a dumb decision. Why'd you do that? And some people got caught, right? Like we've got people right now who are caught. You can actually make a case that there's a lot of examples where today there's a lot of better purchases than the purchases that were made in 21 and 22. I mean, prices were certainly way higher then. Prices have adjusted, but cost of lending has changed. So if you analyze it just from a monthly cash flow perspective, there are deals that you could find today that would analyze on a month-to-month basis very much in the same way as people who were making purchases back then. The difference was right here. Back then, everybody was doing it. Buy real estate, buy real estate. Now nobody goes, no, don't buy real estate. But today you're getting the capital adjustment, right? The place that's 800 is now 650.
Right.
And you can make an argument that today is a way better time, but credit crunch, people are tight on cash. And so we don't see these transactions happening. But the method for approval has stayed the same. It's just that less people either want to do it or can get approved to do it today versus, you know, 3 years ago. Does that make sense?
Yeah, it does make sense. One other question is, do people, has the demand for residential investment properties dropped because of the difficulty with the Residential Tenancy Act? Is that a actual factor where people say, you know, I would like to start pushing my money in other directions because of that difficulty?
Yeah. So, I mean, I think to be able to give a really true answer to that, we need to be able to see how the market responds to the new residential tenancy rules in an equally bullish market.
Yeah, right.
So we, you know, right now, I think a lot of people have used the changes in residential tenancy to say, I'm out, I'm not doing this. And there has certainly been some people who have liquidated assets, got out because they don't like, you know, 3 months versus 2 months notice, stuff like that. But I think to have a fair analysis, we have to go through another booming market. My sense is that I don't think it would have that significant of an impact. I'll tell you what has the bigger issue is the short-term rental stuff, right? So the regular tenancy rules, you know, there was a change. If you want to give notice now, tenants get 3 months. They went to 4, they rolled it back to 3. That to me is little to no consequence. It's the markets that were heavily driven by short-term rentals. And now there's particular markets where they've lost that. So like Kelowna is a great example. There was a ton of condos that were pre-bought in particular buildings based on doing short-term rentals, right? Where you'd be driving, market rent for the condo might be $2,500 a month, but people were factoring getting $6,500 a month. I don't know we haven't seen enough to see what kind of impact that's going to have. But right now you've got the rule changes, plus you've got a bear market.
Yeah.
And so in the short time frame that we have to analyze it, I mean, there's a lot of buildings that haven't even completed yet. Completion's coming up. And you got people who are factoring thousands of dollars more a month. And they're going to have to complete on these units. And they will be eating money. Like they will not cash flow. These places will not cash flow.
Really?
Yeah. And then specifically closer to home, like Cultus Lake was one that was a market that got heavily driven up by short-term rental revenue for obvious reasons, right? Like it's a hot spot for 4 months of the year. I had some of my own active clients in that market. I recently just sold a place there. And the only reason that place sold is because they lost their ability for short-term rental. They would have never sold it. Their plan was to keep it, and it was going to make, you know, upwards of 65 to 75 grand a year in revenue. They lost it. And so there's now, I think with some of these markets that were really heavy on short-term rentals, there's going to be a new, we're going to have to find the base of what the new value is, because the market was so heavily impacted by the ability to do that. Now, what is the value? I don't know. What is the value of like a condo overlooking the water in Kelowna where the entire building sold to people who want to do short-term rentals? Their analysis was based on something that you can't even do anymore. So now you either got to find end users or you got to find people that are willing to buy it, but just do normal long-term rentals, which is way less. The math is completely different. So like in Cultus, I mean, that's, you know, we're seeing some sales come up in Cultus where some of these little cabins that were on like 2,500 square foot lots down in the old section there, in the peak, these things were ripping off at like, well over $1 million, like 1.2 all day long. And there's been a couple sales there now recently for like 860, 870, 880. And, you know, my sense is that, and those weren't easy sales either. Those all took a long time. And all of those buyers I think I can say this with all three sales, they were end user buyers. So we had to find a new market.
Yeah.
Who wants to buy there
Right.
and actually use it themselves?
Right.
Because you're not renting it out, you're not relying on financials. It's just whatever you're going to use it for. So, you know, some of those probably could have easily been 1.2 million in early 22. And now we're down at least 25%.
Wow.
Yeah.
Wow.
Yeah.
That's a value change.
It's a big shift. Yeah. And there's tons of other markets like that, you know, but when you get into like, you know, whether you're talking like anywhere in the Fraser Valley, like is there short-term rentals in Abbotsford, Chilliwack, Langley, Surrey? Yes, of course. But by and large, the market is still driven and dictated by end users and long-term rental values,
Okay.
not short-term. There's pockets in all these communities where short-term became big, maybe in particular complexes or particular neighborhoods. But don't forget, short-term rentals, prior to the rule changes, they were heavily regulated by strata complexes.
Yeah.
Right. So you couldn't get away with it in most stratas anyway. So the values weren't able to be overly inflated because there was rules in place to protect against that already.
Right.
But some of these markets, like in the Okanagan or in Cultus, as an example, it was a free for all. And there was buildings built specifically for that. Like I'm thinking of one building in particular I'm aware of in Kelowna. It was built for that. It had the zoning
adjustment.
And so 95% of the buyers in there, it was basically like a hotel.
Yeah.
And then they lost it. It happened in Osoyoos as well. There's been a few buildings that have been able to retain it. Predator Ridge had to fight to be able to, they had to petition the government. So the whole golf development had to petition the BC government to be able to retain short-term rental ability. And they won, they got it. But like, think about how significant that would have been.
Well, it's like a destination. It's a tourism destination.
Yeah. So if you wanted to retain it, there's thresholds that your development had to meet. Predator Ridge met it. There's a complex in Osoyoos. I think there's a few in Osoyoos that met the threshold as well. But it's so markets like that or complexes like that, there's some significant value adjustments that we have yet to see play out. And we're going to see that here over the course of the next, year or so, I would imagine. Yeah.
So, yeah, I mean, that's, I think, thanks for that. That's a great summary, actually, of what the investment dollars, like what the options are on the residential side, right?
You mean like if people are wanting to invest, like wanting to buy revenue property?
Yeah, buying revenue property. And I think I often get calls from people saying, I've dabbled in residential. I have a handful of residential properties and I really want to get into commercial, right? And that's something that I often have conversations with people, which is totally understandable. It seems to be more carefree and simple, certainly with one business tenant or a handful of business tenants. So that's something that I deal with a fair bit. I would say not that. I guess to understand the pricing and the financing, we need to go back a little bit, and that is to say that the end users, banks have been really focusing on end users buying real estate in the commercial sector for the last handful of years, and that hasn't really adjusted. That hasn't really changed.
And is that just because they're more secure because they have a business cash flow tied to the lending?
Yeah. So, I think that there are the traditional banks. Let's just back up and kind of look at this as an overview for the last 5 years. The banks would generally say BDC specifically was mandated to really help support businesses with their own growth, right? And so for a long period of time, if it was shown that a company, let's say company A, an industrial company, is leasing and they've been leasing for 10 years, they've paid their bills and they want to purchase. Banks in the past have been looking and saying, instead of really evaluating the asset that they want to purchase and saying, let's dive in, what's that appraised value? How much is it going to, they look at the company and say, okay, company ABC, have they been able to pay their bills for 10 years? Yeah. Absolutely, they have been. Do they have good, consistent financial statements? Yes. Are they going to be able to pay their same amount that they have been paying? Yeah, very likely. Yeah. Then the banks would say, now we are willing to give you the money to go buy a strata unit so that you can grow. And they've been doing that at high leverage. So they've been purchasing, or they've been providing up to 100% financing. I just did a deal with an industrial construction company. They're doing very well, and what's ended up happening is these companies haven't searched for high leverage because they need it. They've just looked at this high leverage and said, listen, if I can get 100% financing for a new building I'm going on to, why wouldn't I do that?
Yeah, don't bleed the cash. Yeah.
I'll keep my $2 or $3 million cash. I'll put that back into my business. And the rates really for these industrial users haven't been, typically we'd expect, okay, well, it's high leverage, but you're going to be paying way more. And that hasn't been a reality for us.
Yeah.
They've been competitive rates. As long as you are going to occupy 50, depending on different banks, but at least 50% of the building,
right,
they're happy to give you. As I said, this construction company I'm working with, they're ending up getting almost 110%. So they're getting
money for TIs.
They're getting the entire building paid for, financed, and the improvements, the office space that they're going to be putting, also getting those. So they're actually getting almost 110% financing. And that's not based on the asset going up in value or being this super special industrial asset.
It's just cash flow of the business.
On the strength of the business that is a good business has been operating. So I tell you that background to say, obviously, we have become an end user driven marketplace.
Yeah.
So if you have one group of buyers who can get 110% financing, and then you've got someone else who now isn't an end user, let's just say this is someone who wants to invest in real estate. They want to buy some real estate, right?
Yeah.
So they go to buy some real estate and the bank says, you know what? It's not based on you. It's not based on you.
Because you're not moving your business in there.
Yeah. Now it's just based on the tenant and they don't care really about the building. It's based on the cash flow. And so the standard for investment purposes right now is that you come up with, in most cases, it's done on the debt service ratio, but it usually ends up being around 50% loan to value. So if buyer wants to come and buy a strata unit for investment purposes,
$5 million building, you got to
most buildings, and industrial or, kind of minimum size is going to be $2 to $3 million. You have to come up with half of that.
Yeah.
So you can imagine over the last couple of years, where were the majority of these units? Why was strata all of a sudden, the industrial strata just picked off and went right to through the roof? Guys were getting 100% financing, 110% financing. So what ended up happening is a lot of these end users ended up buying these units.
And some of these guys for years would have been paying whatever, depending on the size, anywhere between $5 to $30,000 a month in rent. They've shown that they can handle the rent in their business for years.
Yes.
And the bank goes, well, you've been paying that in rent. You can just pay it in the form of a loan.
Yeah.
And that's it.
It's reasonable.
Yeah.
So what ended up happening from that, which is odd, is that buildings that have long-term leases on them became less valuable.
Devalued. Yeah.
So I would have owners come to me and say, Todd, I've had a building for 30 years. It's in great shape. I've had the same tenants for 20 years. Boy, I love them. We have a great relationship, but I want to maximize value. What should I do to sell my building? And the answer has been, can you get rid of your tenants? Maybe not get rid of them.
It's kind of different in residential too. I mean, not really, but kind of.
Get rid of, the first question that I would say is, when is your lease up? And they say, well, you don't get it. No, I've got 10. They pay they never pay. And I say, I know. There has been about a 20 to 30% premium that a building would sell for vacant instead of leased. So if you have your typical strata unit,
makes sense.
This is totally counterintuitive to the open market.
Yeah.
Right? Like historically, everyone would say a leased building is worth more. Yeah. But if it's vacant and someone can go get 100% financing and occupy it. So we've had this major discrepancy in what end users are willing and can afford to pay and what investors are. And it would right now, the investment deals, they don't make sense. We're so upside down that because of the financing, we're just, like you say, we're just doing a deal where a bank came back and said they wanted almost 60% down.
Yeah.
For a tenant that was international, a AAA tenant.
Yeah.
Zero concerns. And the bank said, we still get it. But if you're not occupying the building, we'd like 60, and the deal blew up, right? Like who's going to put 60%
it's basically down? Like you could almost, not that this is in writing, but it was almost like the bank may have put in writing, like, we don't really want this deal. We don't want to lend on this. So we're going to do everything we can to make this as much of a pain in the ass as possible.
Yeah.
Even though location was unreal, buildings unreal, tenant was unreal.
Client had a relationship with the bank. Client had been dealing with this bank for extended periods of time, right? For how long? Like 10 or 15 years. They've done all their business as relationship banking. And the bank still kind of looked at it and said, meh, we don't really want it.
And if that exact client had have said, I want to buy that building, I'm going to move into that building and operate my business out of that building, would have got 100% financing.
Well, it would have been a totally different. Yeah, they would have been then.
Literally, that client would have got 100%
that
financing.
client would have got 100% financing. Yeah, in the sense that their business was strong, and so just it's really a different. We joke around and saying that the best way to maximize value in your building, many ways right now, is to have a vacant building. And so what we want to do with that, the reason we want to start asking if there's clients that have buildings coming up for renewal, it's such an important time for me to be able to say to a client, listen, your building's coming up. You have a tenant. Let's say someone has a building that has been tenanted well. You have a building coming up in 2 years from now. What do you want to do? If you want to just release it, because lots of people say, I'm never selling, that's great. But what I would say is if we're going to enter into a new lease agreement for a 10 or a 15-year period, we don't want to be selling this building leased. We want to sell it vacant. So I'm asking these clients now, when the tenant is coming due, if you've got a year and a half and the client's coming up, what do you want to do? But if you say you don't want to sell, that should be the answer for the next 10 or 15 years.
Yeah.
Don't, let's not go get a new tenant in the building. And then a year later, you come tap me on the shoulder and say, I changed my mind. I want to sell it, because now your property's worth 25% less than it was vacant.
Although that's in this moment. And if we go back over the course of the last, 20 years, when and if the lending world shifts again, that could be a different answer, because there was a time, correct me if I'm wrong here, but I mean, there was a time when the discrepancy wasn't there. The banks became bullish on lending to end users, which is really what drove up, the ability to finance for an end user, which is, what you're alluding to.
Yeah. But
if we were in a world where banks weren't as bullish on financing end users, or just dialed back a bit from, 100% financing and 75, 80 or whatever. And then also they were to have a different mindset with buildings that are occupied, and then that could shift, correct? I feel like maybe 2016, 17, 18, this conversation didn't exist.
Well, it's obviously more complex, that it has to do with lease rates as well.
100%.
Right. Yeah. So we're at a time right now, and those are totally fair comments, where I'm really talking about where we are today and in the past. I'm not talking about where we're heading in the future.
Yeah.
And I think now today, what we're talking about, when we'll kind of just stick to, if we're talking about kind of like industrial businesses doing well, now the question becomes, and it's turning to the point where, do industrial buyers want to stretch and purchase strata, or are they better off to lease right now for the time being? Lease rates have come off. Pricing for strata has come off, obviously. Mm-hmm. So has lease rates. But now the demand for purchasing, those end users are also pausing with all of the uncertainty. And even though they can get financing, there is another layer where they're just saying, should I be purchasing right now? Right.
So how are you then landing at value for an empty building, mm-hmm. whether it's freestanding or I mean, I know it's different if it's freestanding or a strata unit, but with a lack of transactions, and it's harder to find comps, there's less movement in general.
Yeah.
How are you with confidence looking at something and going, okay, this is worth X today? What is that? What's involved in that process?
Yeah. So great point again, talking about commercial. One of the things that I'd like to lay out is that even finding comparable data is much different, right? So we're talking about these drivers. Obviously, sale prices per square foot are what we use to track. But in many cases, the lease rates, we have to do some additional math to see how the lease rates are working to support the values of the properties, right? So the lease rates are coming down, and that is an alternative for other tenants, for buyers to be looking. But the way that we're valuing the property is really the same way to look back to see where the market was at its height. Yeah. To see where in general prices have dropped from there, and to try to really find the spot where when they've dropped, how do I want to say this? I'm not saying this in the correct way. It's really the same exercise like when you were describing going down and finding the benchmark pricing.
When we were talking about stats in the meeting.
Exactly.
So okay, then I would say, so I talked about we talked about home price index, median, average values, and they're all different for different segments.
Yep.
But if we took a particular segment, I would say like, so let's go. Well, I talked about the townhouse market, right? We were talking about Abbotsford townhomes, and I said home price index since peak in early 22, contrary to what many people would say or think, is down about 10%.
Yeah.
Okay. And we have that because we have enough sales, both in peak and past peak, to be able to measure and create the analysis, right? This stuff is done for us with our board stats. I know it's different for you guys don't have access to the same data, but I guess my question is, so if we take a particular asset class, like let's go, strata industrial.
Yeah.
What do you have that data where you can just whip off and go like, we're down 15 points or 10 points,
right.
Or is it not that simple?
Yeah, the data is much harder to find. The data, like one of the main reasons is, I think, what do they say that certainly less than 50% of commercial transactions are posted on CLS.
Yeah, so there is.
So when we're in the meeting in the company team meeting here, and we're talking about the way that you can grab the data and you can really define, here's a condo that sold 5 years ago. Here's what the other condos. To be able to find that data is an incredible advantage that you have on the residential side. So we have a couple systems that we use to track sales, but they really track sales through title changes.
Yeah, time of completion.
And then there's usually a 3 to 4 month lag.
Right, because stuff doesn't register right
because
away.
It doesn't register right away. So definitely a gap. That's one reason why I would say it is difficult to be a commercial agent when you dabble in commercial agents, right? Or in commercial real estate. So you either know both through data and kind of anecdotally what's going on. Like a lot of this is in it every day. I was on the phone this morning talking to another agent who's saying, hey, I've seen the pricing going on in this project. They're dropping their pricing. Here's where they're at. Yeah. And so if you're not in, not just commercial real estate, if you're not in that specific asset class, diving in and on the phone and relating to people in everyday situations, it's very, very hard to track what's going on. So few data points for sales. Yeah. I was just pulling strata sales in the last couple of months, going back and tracking over year over year. And there's months where there's like less than 10 transactions in the Fraser Valley. Like there's so few transactions to find. It's very
but the reality is there might be 50 transactions. It's just that they're not tracked on commercial MLS.
Yeah, exactly. So
why is that? I know, I think I know, but like, why in the commercial world do people think they should not share information? Yeah, that's really what it is. They're not sharing information.
Yeah. I think that there's certainly, I could talk about what my philosophy has been on it. And that has been, even at Frontline when we ran that, working in the Fraser Valley, it's a disservice, I think, to your clients to not put it on CLS. Like there's so much exposure. You have no idea where your deal's coming from. A lot of times agents do it because they don't want to deal with non-commercial agents. To be honest, if you're dealing with like someone who has experience doing leases, it's an entirely different situation.
Well, you're doing all the work.
You're doing all the work. So a lot of it is just out of laziness. Yeah. It's a pretty small community in commercial. So you get to know, much like residential, I'm sure, but there's a handful of people that do the majority of the deals in commercial. So it's a very small world, and they like to kind of trade with that information on the inside. But it's a disservice, I think, certainly when we're looking at doing in the Fraser Valley from Surrey to Chilliwack, so many deals and so many business owners. So many of my clients own an industrial building. They happen to have some retail. They have a couple of residential buildings, and they have a vacation. Like, it's very common for people to have a whole mix of properties. And that means that one client has to have a variety of different services available to them, right? Yeah. So, it should be on CLS. I certainly do.
It's just, it's one of those things that's held on in the evolution of real estate over the last 20 years. That one piece of the commercial industry, keeping everything tight to chest, not putting everything out publicly. That's just,
the other thing is on CLS and MLS, you have to post what fees you're getting and paying. And some ambiguity around that is often more advantageous for listing brokers.
Right. Because they don't want to offer quote. Yeah.
Honestly, if there's sometimes someone calls and they're going to, is representing a buyer and they want to get the same fee, and it's saying it's kind of not worth it to work with that person. So that is the concern. That's not the concern that I have. I've gone out of my way to go in the opposite. And frankly, what happens doing the deal right now where a residential agent called me, they have the tenant and they said, Todd, I have no idea what I'm doing.
Yeah.
Can you help me along the way? And absolutely, I'll help along the way. In the interest of doing the deal, that's how I think it should be be handled. Yeah. So that was your that's the polite version.
Yeah, no. It's just what there's whatever. You know how I feel. I think we talked about this, like the power that's gathered from the collection of data and stats. It is actually an incredible tool that would further enable the elite within the commercial industry to do an even better job. And I think that they hang on to it. Can't say I'm inside these people's minds, but I believe that their effort to hang on to it and protect it, they think that's what gives them their competitive advantage. They think that, well, if I'm the only guy that has all this information, then everybody has to come to me, which is what then makes me who I am. And I would argue that if everything was accessible and available as it is in the residential world, if you are elite, you will learn to, and you'll have better access to more data. You'll better interpret it than anyone else because you're elite. And now it'll further help you in doing what you're already doing. This idea of like protectionism and holding back from the rest of the market. I think we have evidence of it in the residential market that like, it's not like, somebody that, is elite in the residential market isn't as elite because now the data is available to a lower competitor. You know what I mean?
Yeah. I mean, if I take the other side of that, I would say there is some value. Like the other thing that commercial agents do that's annoying is they don't list the price of the property. Right? Like we'll put on there, call and ask the agent. Well, why do you have to call to ask? It's either $17 or $18 a foot. Like what's the difference? And I think the same thing with, we leave signs up forever. Right.
Yeah.
We want people to make incoming calls.
Sure. Yeah.
So, I think one of the reasons that commercial agents have all those is it's tough to find buyers and sellers. We want to have as many people calling us as possible.
Yeah.
So when I want someone, if someone from a downtown shop lists it just on their website, and you can't get the information from CLS, it essentially funnels the buyer
Everybody
or
has
the seller
to
and that's what you remember at the beginning of this. We said it's hard to find people that want to buy and sell. So your first job is narrowing down to find the humans that actually want to do a transaction. So it's a different mentality. I mean, it's left I just got a call on Friday from a client that I'm working with in town, and they said, hey, I'm looking for 20,000 square feet to lease. And I am so frustrated, Todd. I can't even find a central place to see what's on the market. Right.
Totally.
Like I've gone through
you gotta go to 19 different,
gone through. And so it's funny. I've even built a tool. So I've built a tool in the last couple of years that I have a team that goes in my back end that will basically build an inventory, a CLS list, right? So that they'll take everything that's on CLS. Then I will have someone go scout out all of the
major websites,
every day, the major websites, and say, what's new? We'll call them. Basically, I have someone building my active inventory.
Like the time waste that goes into that.
I mean, I'm paying for all of it to be done daily.
Yeah.
So that when that client calls and says, Todd, I can't find 20,000 square feet, I don't even know where to look. What I say to them is, great, give me 48 hours, give me a list of criteria that you're looking for, and I will provide you a survey of what the available options are. So in commercial, we're dealing with very, very limited information. And guess what? The other brokers do not want to share the information with you.
Right.
Information is power.
Yeah.
Right. And they're not looking to help. They're looking to make a buck for their own. So the information is hoarded. One thing, to make educated decisions on sale prices and what you need to have lease information. Leases that are completed are not posted anywhere. There's no central database for leasing.
Right. So how does a person get you?
You track it for 15 years.
Yeah.
And you have your own spreadsheets and you talk to different people in the market and you know what that leased for and you know what that leased for and you're talking to but you are gathering information. Half of the time of your job is gathering information so you actually know what's going on.
How many business and building owners do you have in your database that you've tracked in the Fraser Valley?
Yeah. So that's one thing over an extended period of time. I'd say we have about 14,000. And that is what we ended up doing is when we would start farming. I know that you talk a lot about farming certain areas. So over the years, I would say we're going to farm Aldergrove, the industrial area in Aldergrove. So, it would have a very specific.
Am I okay in the screen? Okay, mine are time out there for batteries. We're back live.
Sorry.
Are we in the screen? We're good? Okay. Okay. Just pick up where we left off. I was
just talking about the inventory being difficult to manage. I was just talking about lease rates.
No. But we were talking about your, the number of buildings and property owners that you'd said 14,000 database.
Yeah.
And so the point of the story is you spent however many years gathering that data because you don't have tracking through a commercial CLS where everybody can get that. I mean, you're not going to get people's personal names or company, you have to search that through title searches anyway, but you don't have the data, you don't have the sales track. And then the other thing you said was leases. When leases are done, that's tracked nowhere.
Yeah. So I think maybe my point is that it's incomplete information. Commercial real estate is kind of all over the place. We've got incomplete information that's really, really hard to track. And so I tell you what I've built the background to overcome some of these and to let you know what it kind of takes to actually be in the industry every day and kind of. So I just think that, commercial agents that know, and then I would even say there's the different asset classes.
Yeah.
Like, industrial right now. I was just talking to a gentleman this morning about office in the suburbs and to hear how, downtown office is just absolutely dead in terms of the movement. There is a gentleman told me, a year and a half ago, there was, if you wanted a single floor of like to lease a single floor for office in downtown there, you couldn't find one, or there would be one at any given time in the market for a handful of years. Now there's up to 50 full floors that you could have. Downtown Vancouver.
Yeah.
So if you're a tenant and you want to go find space in Vancouver, it's like that is the absolute place to be. So office is dead, with the exception of in the suburbs, up and down 200 Street, when you've got in city center by the hospital, you got a bunch of different units that are still moving. And so in commercial, even in the small nodes, it's both geographic. You need to have a really good understanding of geographically where things are moving. And it can be, what are we talking about? That's 45, half an hour away from downtown to suburbs.
But that would be because, I don't know, tell me if this is accurate. That would be because the downtown office market is driven by a totally different type of business class than like city center Langley.
Absolutely.
City center Langley might be like, whatever, local law firm that wants 10,000 feet because they're going to put their office space there, whatever. Downtown Vancouver is driven, I would imagine, heavily by major banks, big
tech.
National corporations, tech, like huge companies, which have been massively downsizing their real estate footprint in the post-COVID world.
Yeah.
It's actually kind of like, there's a correlation there too with just the industrial conversation in the Valley is largely driven by like regular people running regular small businesses, right? Like guys, you're a small plumbing company, you're a small drywall company, you're electrical contracting company, and whatever, you've got anywhere between 3 to 30 employees.
Yeah.
That's the people driving the Fraser Valley market.
Correct.
Versus if you go to industrial, that's more out, you cross the bridge, you get down by the river. Now you're bigger shops, bigger names, correct?
Yeah, less so than, we don't have a massive corporate like, Calgary would be even more so kind of like big corporate distribution heavy.
Yeah.
You would like
Amazon.
Exactly. And IKEA and all the guys, they're all going to have their big distribution shops. Whereas certainly in the Fraser Valley, and certainly my focus, I haven't been going after Pepsi or Coke or any of these large national, international tenants. Our bread and butter is exactly. The people of the Fraser Valley that own and operate businesses, and they're, for the most part, have done really well in the past, and they're still looking to expand and driving their own business.
So what does your crystal ball say? We have an election in 2 weeks.
Yeah.
The market's been what the market's been.
Yeah.
So what are you saying to your people? Someone looks in the eye and goes, Todd, is this What do I expect? What, like, do I buy now? Do I wait to buy? What's the market going to do? I mean, lending obviously has a big impact, but what's your talking points in that conversation?
Yeah. Great question. Interesting timing right now for lots of reasons. I think that the market has dropped. Let's just stick with industrial right now in the Fraser Valley, just because, again, I want to be really careful about talking with different asset classes. And kind of the main asset classes that I would have in the Fraser Valley would be industrial, and just for clarity, commercial, which I kind of refer to as office and retail.
Yeah.
And then development land, which would be multifamily development land. So those
totally.
are,
we should talk about land. Get through this answer, then we
Sure.
should talk about land.
Sure. So what I would underpin, I'm going to just talk to industrial right now. That's for the last handful of years, industrial has been the most desirable asset, almost 0% vacancy across the board. And so a lot of people in commercial real estate have been kind of flocking to industrial, low risk.
Yeah.
The fundamentals have been strong.
Concrete tilt up, pressure wash it when it's dirty.
I love industrial. So here's the one reason I love industrial is, like, you have a tenant in there working or occupying the space, and then they're gone and another tenant wants to come in. The beautiful thing about industrial is it's concrete.
Yeah, totally.
It's got a, 1,000 square foot office and a washroom. And you know what the next tenant wants? That.
Yeah,
They just want a box.
And they can't wreck it either.
It's tough. Yeah, I mean,
it's like, he peed on the carpets. Well, there's no carpets. Just pee on the concrete, whatever.
They do try to wreck it. Yeah. But, industrial is pretty basic.
They can start changing oil.
Please don't. Please don't change
That's a problem. Yeah, there's a little bit of oil over here. We're just going to cover it up.
Opposed to, you think about an office or a retail building. So then every time, let's pick, you've got a dentist in there, and their term is up and they want to leave. And then the next person that is in there is a nail salon or a nail shop.
Yeah.
They want nothing to do with, so then every time or often when there's a renewal on tenants,
you got to do TIs.
The landlord's got to contribute to that, right?
Yeah.
Whether it's 20, 30, 40 bucks a foot, or you got to rip everything
20, 30, hundreds of dollars a foot.
Exactly.
Yeah.
Exactly. So on the office retail side, it's much more often expensive to be a landlord, whereas on the industrial side. So that's one thing to consider. The other thing in the open market is industrial. Let's just talk about supply and demand. So let's back up 4 years.
Yeah.
I would say our demand was even through COVID, our demand was at a 9 or a 10.
It was absurd.
So these businesses have been doing, everyone couldn't stop the growth, right? So just more business than we know what to do with. And for industrial, supply was at about a 2 out of 10. So about 8 years ago, Henry Braun was actually quoted as coming out and saying, we're out of land. We're out of industrial land in 10 years. And that really spurred on a real buying spree for people to say, look, if I don't buy my industrial real estate now, I'm never getting it.
Yeah.
So we're
also driven by the fact that a lot of these people that bought or tried to buy, they were tenants for however long, and you couldn't even find a place to rent.
Exactly.
Like, so a lot of those people, it was like, I've been renting here. I can't renew.
Yeah.
I can't find another place to even go rent. I have to buy.
Yes.
And that wasn't easy.
Right. And so what happened is prices just shot absolutely through the roof. So industrial had this massive increase in pricing. Yeah. Right. Driven by what we talked about, the end users who then could get 100 to 110% financing, growth in the business, and the ability to actually execute and buy. So our supply was at a 2, I'm going to reiterate, and our demand was at a 9 or a 10. Yeah. So switch to today. Well, here's what we have for industrial land. We have mountains, we have an ocean, we have a border, and we have ALR.
Yeah.
So when we look at the actual laws of supply and demand, there's very, very few new pieces of industrial land being brought to market. Yeah. So our supply, although there's been some vacancy and there's certainly more on the market, our supply has gone up. Let's say instead of our supply being a 2 out of 10, it's a 3 or 4.
Yeah, hardly. It's up a little bit.
Our vacancy is maybe still less than 5%. Whereas, it was 1% for a long period of time, right? So we've got supply still limited, and we've got demand that has come from a 9 to 3 out of 10 for all of the reasons we know are true, right? Tariffs, uncertainty, our own country's leadership, and all these different things that we've got to deal with here. So what's going to happen in the future? So obviously we're at a slow spot. It's pretty tough to, most businesses are watching their cash, being mindful. Large expenditures are often not part of the equation right now, and everyone's being tentative and cautious.
Yeah.
So they should be, right?
Yeah.
On one side of it, the other reality is, my feeling is, as soon as demand, so we're kind of even right now, or let's say supply is slightly higher than demand right now, which would make sense. Our prices are dropping. Yeah. So supplies of 4, demand.
But it's not like residential though. There is not supply in the specifically the industrial space like there is. Like we're at all-time highs for supply in residential, and you're nowhere near that in industrial. Right.
And so my question is, what's going to happen as soon as demand gets back up above a 4 out of 10? And it's not here today, but is it 6 months? Is it 12 months? So what happens if the U.S. economy is spurred on and really encouraged for new growth? What happens? I mean, our election is a big deal.
Yeah.
Right.
Yeah.
What's the climate going to be for businesses in our community? And the reality is we're going to have to see what happens. But the reality is we don't have supply in this area. We don't have any more. There's no more. Yeah. With ALR as strong as they are, and really their mandate is not to develop, it's to protect, right? So I think we get confused and sometimes want the ALR to play nice, but the reality is their mandate is to protect
they don't give a
land, right? And that's what they're built to do. So demand is going to increase and will surpass supply again. The question is, when is that going to happen? And I don't know how we're going to respond when the supply is still required. So yes, we have supply of industrial land. If you said, Todd, I want to find a 10-acre piece of industrial land for sale or for lease right now for an operating business, I still can't find you a 10-acre piece that I have anywhere.
But if somebody said, Todd, I want to go buy a 3,500 square foot industrial unit in a reasonable building in a good location, you can find it today. Whereas 3 years ago, you couldn't get it 3 years ago.
Absolutely. Yeah.
But the difference is though, like so again, maybe we can't exactly quantify it because we don't have all the data that's easily compiled, but you would be able to say, hey, generally speaking, how much are prices down from 2 years ago? And the reality is on those spaces, you're down probably what, 10, 15%?
I'd say you're down 20 to 25%.
It's that big.
Yeah. For if we're picking strata, if we're picking and again, we're sticking with industrial now. I want to be specific. If we're picking industrial strata units. Yeah. Yeah. If we're picking industrial land right now, you couldn't buy land or you couldn't lease land, and there is opportunity now. So there's certainly more opportunities and inventories should you have need right now to be able to find reasonable solutions.
Bare industrial land, let's say, I don't know, let's go Aldergrove, Mount Lehman area. Yep. That kind of capped out at what, $5 an acre? $5 million an acre?
The peak was 5.7 per acre.
And today it would be
4.5.
Yeah. Just for the land.
For the land. And again, let's pick that for land. If you are an end user going to buy the land, you'd probably be able to get 90 to 100% financing.
You get the building built.
If you are a developer or an investor and someone that wants to get industrial, or just into the game, you would likely have to put 50% down as a minimum. Yeah. So you can, it's just eliminating all of the developers can't buy it because they don't want to put the cash down. Speculative investors aren't buying it. So really you're only leaving end users to be purchasing those assets right now. And a lot of end users are being pretty cautious right now because they don't know how to plan for the environment, the political environment. It is a little bit paralyzing. And I mean, I would counter that by saying, as we've talked about with residential, it kind of feels like an awesome time to buy in the sense that the values are down as well. It's like, it depends on.
Totally. This is the same thing. Like, if you go back to any recessionary time, sales volumes drop through the floor and everyone has a reason not to transact. And then in retrospect, everyone goes, well, I wish I had bought then. I mean, we've seen this story play out before. I mean, the last most recent similar example was post-financial crisis. Our sales volume in 2009 and parts of 10, 11, 12 was very similar to what we're experiencing now on a residential side. It was probably similar on commercial side, I would imagine. And everybody wishes they had bought real estate then. By the time we got to 2015, 16, when things picked up again, once again, it was the environment was different and everyone was transacting and everyone wished they had been that smart guy that bought something in 2010. So I don't doubt for a second, the opportunity right now is unbelievable. It's hard for people to transact. It's hard to get the lending, but because of the adjustment in values, we will not see these values again. I know that every time we go through something like this, there's always the naysayers that go like, oh, I don't know, this could be it. This could be when the world implodes and, everything's going to go up in smoke. That is, when you look at the measurables that dictate value, you hit on it, one element. And one element, the biggest element, is availability of land to develop. And then the other piece, which I want to get into because I want to talk about development land, is the cost to develop and construct. So right now, while we don't have industrial strata units selling at the pace that maybe they were, here's the other thing that's going on. Developers who actually have industrial land that they could develop today, they're not developing it. Well, why? Why would they go through the risk and all of the cost only to look and say, well, if I go today, I'm only going to be able to sell it for so much per square foot.
Yeah.
That doesn't make sense. I can't build and develop because of all of the costs associated provincially, locally, whatever, DCCs, all this crap. It just doesn't make sense. Yeah. So right now we're in a moment, residentially and commercially, where developers have put the brakes on. All that does is that pushes the problem down the road. And then the moment the market takes off again and buyer demand returns, we now haven't been building for how many years? Like, who is starting a new industrial building right now? Nobody.
Right, exactly.
Who's starting a new housing or townhouse development? Very few people. So we are now just creating another bubble, another problem for, who is it? Is it a year down the road, 2 years down the road?
Yeah.
Who knows, but it's going to come.
Yeah. So I'd love to speak to that too. Exactly those numbers. A developer can't afford to buy the land and develop. So I said in Abbotsford, the pricing is about $4.5 million per acre. Yeah. That is priced. And again, you always, when you're talking to a commercial agent, you have to talk about who are we selling that to. So an end user will pay $4.5 million an acre because they can get good financing. A developer who has to pay 50%, has to have all this uncertainty, they can pay less than $3 million an acre for the land. Yeah. So developers are out. Yeah. They're not buying land right now. There's so many uncertainty. There's so many questions about what happens. So that's where I kind of wanted to, I'm talking a lot about financing and how it works. I often get people come to me and they say, hey, I've got some money. I want to find a building, put lipstick on it, and then I want to improve it. I want to sell it for. I've got some sweat equity I can put into it, right? Yeah. And so people often ask, what is the way to make money in real estate right now? And I actually think the way to tap into real estate is not by buying a building, putting some lipstick and fixing it up. It's figuring out a way to get an advantage to finance the property. So I think there's an incredible opportunity for business owners right now who are leasing, who have, or in a smaller strata, or in a building right now, who have stability of income. They're not really shaken by this uncertainty. And I think it's an incredible time to buy because they can go get financing at a rate that other people can't get the financing at. And it sets them up. That's your strategic advantage. So if there's people out there in the market that want to buy, instead of looking at how to fix up the building, I think what they should look is say, is there an opportunity for me to change my financing? My favorite success stories are like, there's a couple of guys in Port Kells that I've dealt with over the years who 15 years, 20, 30 years ago bought a building. Yeah. They bought a building twice as big as they need. Yeah. So they have occupied 50% of the building. Yeah. Over the years, they grew into it. Yeah. They made an okay living as a welder or as a window man or whatever. They did an okay living, but they made incredible wealth on their real estate. So my perfect buy for people right now is an end user who could go check out their financing. And let's say they need 4,000 square feet of warehouse. Personally, They can go buy 8,000 square feet because they still get the benefit of end user financing. Because
you occupy 50% of the building.
50% of it. You have somebody else paying off your mortgage. You have the ability to grow or contract.
Or just rent it out.
Or rent it out. And you get to take advantage of financing that the rest of the world doesn't get to take advantage of. If you're a rich guy with $1 billion in your jeans, you still have to pay 50% loan to value when you go buy that property. If you're an end user with a good track record, you get to
Yeah.
You get it for, so in my mind, the way to take advantage of the market, if possible, is take advantage of the way you can finance a property.
Yeah.
That's the value add.
Plus you're getting the adjusted values that we just discussed. The
Plus
market has
30% down.
Yeah. So you are getting the best of both worlds. Yeah.
So that's when that is the way to value add. My first question is, and very few people have done research into the financing. I have a handful of people that I would plug clients into right away that say, before we talk about buying, let me see your financials for the last 3 years and I'll tell you what your financing is going to be.
Yeah.
It's a way different model than going to find the building.
Yeah.
Then look at the financing. Like, let's take advantage of where you stand out and are not the same as everybody else.
Yeah.
And that often is through financing. Yeah. So just a little value add, in my opinion, before we get into the land.
I want to talk about land. Is the camera overheating?
Worst case scenario.
Apparently the camera's overheating. We can't get through a freaking podcast without something going wrong. Whatever, it's fine. If the camera cuts off, we'll just be audio. Okay, land value. I want to be careful of your time here, but I want to talk a little bit about land value.
Sure.
So, you hit on it a brief time ago when you talked about how you said, when you're talking about industrial, like, well, 4.5 million in Abbotsford, that's the value based on an end user.
Yeah.
But then the second part to that thought is if somebody has to buy dirt today, and now we'll switch into, all property types.
Okay, sure.
You got to buy dirt today, take it through a development process, pay all the exorbitant fees associated with, provincial and local crap, build a building at a time where it's very expensive to build, whether you're building, wood frame construction or concrete tilt-up or whatever, and then sell it into the marketplace where we know the marketplace is depressed in all asset classes right now. There are many of it. You and I have been working on this together very recently in a few different pieces. You could make an argument that land is worth nothing in some cases right now, just because of the cost to construct and take a property through a development. So what's the best way for us to have this kind of conversation at a high level that people can understand? Should we define residual land value?
Yeah, I think so. Because I think that the way that, let's talk about multifamily land, right? The way that it has traded for the last 5 years has been really through the comparable sales approach. So, you have let's just pick, you have a house on 2.5 acres. What has it been worth? Well, and let's pick this. Let's say you got a 2.5 acre site in Surrey somewhere. So there's potential for development. Everything else has been selling around the area. Yeah. Of course, the comparable approach is the method that was used to evaluate these properties. So, 2021, 22, 23, it's like, well, what was the one across the street? Well, that sold for $5 million an acre. Well, then ours must be worth $5 million an acre. And so, that's how the majority of the valuations were done.
Including, like, we've seen some of these done by appraisal companies. We're not talking about real estate agents. We're talking about licensed appraisal companies where they just did a comparable aspect. They did not go into the depth of a residual land value, which is what you're.
Yeah. So just what are the comparable approach? And the numbers were moving so quickly in increasing that by the time someone would buy and close a site and reevaluate it, it had jumped up another $1 million. Yeah. So they were flipping it out, and we were chasing these numbers that were, they're not made up. They were real numbers because something's worth, my opinion is something's worth what someone will pay for it. So in the time where that was trading, those numbers were trading, residential land was trading at these numbers because someone was willing to buy it. What was not happening was developers actually doing their math and saying, this is how much I can afford to pay for the land and still make profit.
Yeah. So I would say that amidst those years, there was still developers who have those functions built into the operations of their company. They were doing those things. But what happened in those years is there was a increased amount of, we'll call them, inexperienced developers or less sophisticated developers who were unnaturally impacting the value of the market because of the number of transactions that were being transacted by them. So you would get a scenario where, like, you take a developer who's been around for 30 years, and then you wonder why they're not buying that site. And they go, well, yeah, we're out on that site because that site only makes sense at 3.8 million an acre, and then it sells at 4.8 million an acre. And you could say, well, to your point, well, that is the market value. That's what a buyer was willing to pay. But that buyer made a lot of assumptions in that process that were speculative. And like, I've seen, you and I both looked at like firsthand examples where like condo market in South Surrey, the real market at said time was only $900 a foot. That's what was being yielded at that time. But when these guys were buying dirt to develop, because of the pace of the market, they were telling themselves in their brain that when they went to sell that 4 years later, they were going to be selling at $1,000 a foot.
Yeah.
$1,000 a foot never got hit.
Right.
Or if it got hit, it got brushed and then came back. But that is, you know, that's not a residual land value. That's making a lot of assumptions based off of garbage or incomplete information. And today now,
right. But can we just pause? That worked. It worked great. People made tons of money.
It worked as long as the market continued to inflate at that pace, because a lot of those guys would get into something that they probably never should have been in and then flip it out even again and maybe not even develop it. And they go, oh, look at this. I just made 500 grand an acre for doing nothing.
Yeah.
But here now, though, we lie in a corrective time where it's been shocking for me to see this firsthand. I mean, you've walked me into this, and I've worked on a few things with you, and there are actually pieces of land, nice pieces of land in Langley and Surrey and Abbotsford right now, where if you were to go and knock on the door of the top 15 developers in the region, big boys, not small out of the back of the truck, big boys, the big boys would actually say, I either can't give you any money for the land, or the money that I'm giving you for that land is a fraction of whatever it was worth. And it's a few things. It's not just that the market's corrected that much. It's that all of the costs involved in developing have gone through the roof.
Yeah.
Like it's insane. So you can't even buy, even if you got the land for free, you can't necessarily get the product to market at a number that the market will bear and still make, what a developer want, 15, 16% margin. Like it is incredible to see that right now.
So let's jump into that. I mean, anecdotally, I've got a couple of years ago, right in the heat of the market, good client of mine had a property, 5 acres, and the prices were changing so fast and increasing so high. We got an offer, and it was at ask, and I called the client today. Hey, this looks like a good one. And I think they wanted 60 or 90 days for due diligence. I think they wanted 60 days, which is typical for a 5 acre land deal, right? Lots of stuff to do.
Yeah.
And, I called the seller and said, great, we got the number. Let's sell this thing. And he said, no, Todd, I'm not taking it. And I said, what do you like? We're just about to ask, what are we doing? And he said, every month that I wait, my property goes up $1 million in value.
Yeah.
So I get it. This sounds crazy, but tell them to pound sand. And I was shocked, and we did. We told the buyer to pound sand, and sure enough, 2 months later, he sold the property for a couple $1 million more. That's how wild the market was, right? It was like, it didn't make sense. It was just moving. So to hear where we are today, I think what we're talking about is ultimately there's a ton of land listings out there. Everywhere. They are still stuck with the comparative approach, which is kind of wild because nothing has really transacted. And it's certainly not what it was for, we're talking about multifamily development land at 4 million an acre or whatever. We know it's less than that. Yeah. So what we've taken time to do, and we've worked through this, is work out the residual land value. Residual land value meaning what is left over. So once a developer actually does the math, this is what they can afford to pay for the land. So very simply stated, we start with the income. Once this project, let's say it's a townhouse development. Yep. When these townhouses are all built, how much can we sell these townhouses for? Yeah. Right. And how long are they going to take to sell? So then we get our revenue number over time. I mean, I think we all agree now the revenue number is going to be a lot lower than it was a couple of years ago. And the time is going to be a lot longer to just sell the units, right? Yeah. So we've got our revenue number.
And that's assuming you get shovels in the ground right away. There's some sites where it's like, well, we can buy it, but we can only get shovels in the ground in 24 months. So then now you've got an initial hold period, then you have a build period, right? And the time to absorb the units. You could easily be factoring in a 10-year project, and you have to factor in cost on debt that entire
Absolutely.
time. That's one component.
Holding costs. You're just going to. So, when we're in Surrey right now, I would say if we were going to start a development application, it would be 4.5 years before it's done. Yeah. That's when you're starting the application, right? Yeah. So everything's a 5-year project. Yeah. Now it's expensive to hold money for 5 years while you're doing these projects. So we've got the revenue on the top line. That's how much money's going to come in. Then we subtract from that revenue our construction cost. Yeah. Right? Total, hard, soft. You can do a million line items, or you can do general line items here and say, and then you've got profit. You also have to subtract your profit, 15 to 20%. No developer is going to do a job for free. So when you take the income, the construction cost, then you subtract the profit that he's making, that is what you are left with the land that they can afford to pay for that land. Yeah. So the residual approach is really when developers are doing the math and saying, okay, realistically, here's what I can build. It's not just we're not looking at the site and guessing. It's like, realistically, how many units can we fit on there? How much can we sell them for? What's it going to cost to actually construct the building? And how much can we afford to pay for the land? And the reality is that developers who are actually, and if you want to know what a property's worth, that's really the only way. Comparative approach, what does it mean? It's an indication of what other people have also what other choices people have made. But the real math is, if you want to know who's going to buy your site right now, it's from the developer's mouth. It's looking at their math. Yeah. And the reality is, a lot of the properties we've looked at are less than half, if there's any value there. And that's because these variables have changed. So obviously the end price of the units is dramatically dropped. The absorption timeline dramatically changed. It's a lot longer. Municipal costs are insane. Andrew, we just went through one, and the municipal cost for a regular townhouse development was $2.4 million.
What was that thing that we found? There was a new charge.
There was the library. Was 100.
What was that? We found that was in Cloverdale. There was a library. It's the most ridiculous thing, but it was another
line item.
It was another line item, and it was 6 figures.
It was huge money. So we've got dealing with municipalities and their fees, dealing with the municipalities and their timeline. So we just talked about holding this we also talked about on these development pieces where the banks now want you to put still 50% of the land value up front. Yeah. So all of these reasons that developers are having to lay out the cash and then make a fabricated or some assumptions about what the market's going to be in 10 years when they're actually selling the product. Yeah. So there's so much risk involved right now. And at the same time, you're talking to these developers who you want to buy, hey guys, you interested in buying? And they're talking about the traffic on their site, saying there's no traffic. Yeah. People aren't
or they have a slated completion coming up and they're wondering how many people aren't going to be able to
exactly. Yeah. So there is so much uncertainty that these land values, the reality of what a serious buyer is going to pay is so much different than what the vendors had hoped. So, I've been spending a lot of time really helping. I think we both have recently, when people are knocking on the door saying, hey, we just want to know what this property's worth, and that's an honest spot where a lot of people, it was easy to use the comparative approach in the past couple of years. And you can say, well, this is what it's going to be worth. It's very hard without doing hours and hours of work to throw in a residual land value. It's hard to know what a property's worth. And so we've been spending a lot of time. I've been digging in and looking at a lot of different sites saying, I know you hoped it was worth this. Yeah. Let's do some math and the conversation is, do you really want to know what a developer is going to pay? Because this is the math theory. We can negotiate. We can talk about the math being, we can argue whether the number for a condo is $1 million or $950. But that's really what we're talking about, is negotiating the numbers to figure out.
Yeah. And that's a huge component of what's changed. For a number of years, I think probably every level of developer did this. If they were looking at a site in 2018 or 2020, and they looked at the current data of the market, and the current data said, this product is worth $900 a foot. Yeah. A lot of people were okay going, well, by the time we get around to selling this, we're going to plug in a 10% lift. So it's going to be $990 a foot, even though that we hadn't got there. There was no $990 available. Probably everybody did that.
Absolutely.
And today, that's absolutely not happening. So if that same product is now selling for $800 a foot, guess what's going in the pro forma? Guess what's going in the residual land value? Yeah. $800 a foot. And that is right now crushing development land values.
So not only are they not willing to use future values, how do you want someone to estimate what their costs are going to be right now?
Yeah.
Forget about the revenues. Like, you can at least make some kind of assumptions about but how do you deal with what your costs are going to be?
Yeah.
Nobody, look at where are you getting material from right now?
Yeah.
Like, how do you begin to nail down? So my developer clients say, like, look, if you want me to use a future value for the revenue, okay, I'm also going to use a future value for costs.
And it offsets it.
It offsets it. So you use today's value for both, or tomorrow's value for both is just wildly more inaccurate.
Yeah.
Why wouldn't you use today's value for both? But you're absolutely right. There's so many of the sites that we sold in the past where you would assume that by the time you sold the site, there's going to be a 20% increase in the value. That takes
Why?
care
Well,
of
because
you can make a lot of bad decisions and let the market bail you out. And we're in the exact opposite spot right now.
Yeah.
So the first step for vendors is knowing what they have. And the only way to really know what you have for development land is to do that residual land value, go through all of the line items and say, in reality, this is what a developer in this market will pay. There aren't people buying speculative land right now. Like, there aren't people who are paying $2 to $3 million to wait for a land hold. It doesn't, like, you need to see a plan and an exit strategy for these development pieces. And the only way to do that is to run a residual and to do some actual math.
Yeah.
And to figure out what
which involves like hours of work. And you mean who you know obviously makes a big difference getting the work done. But I mean,
it's as accurate as the time you want to put in. So if you want to guess what construction cost is and do it all in the back of napkin, then it's worth that. If you want to dive in and figure out what your actual costs and revenues are going to be, then there's that much value. But so lots of work being done, just helping getting it understanding.
But that's the reason why a site on 200th, which was and could have sold for 9-10 million an acre, is sitting at 5 million an acre right now. And no one's buying it because anybody who's in the development game runs the numbers and goes, I can't build this and get it to market at a price that the market will bear. The land is worth maybe nothing, maybe $1 million an acre, maybe $2 million an acre. At some point, somebody grabs it. Somebody, some of this stuff is going to get picked up by developers who, have the financial wherewithal, because the reality is everything is drastically on sale. And some of these sites are premium sites, like that one on 200th that I'm mentioning. But even if it gets picked up today, shovels aren't going in the ground today. Nobody wants to put shovels in the ground. They only want to put shovels in the ground when they see light at the end of the tunnel. Again, just furthering this, we are locked in this moment of the last 24 to even 36 months where we've had such little amount of new development that when the demand returns, we've created another bubble problem for ourselves, because when it returns, we're going to have no product.
So is that what you see on the demand side? Like for when these projects get back up and running?
Well, we're going to have, I don't know that it would be great to have I'm sure somebody does have the exact numbers, but it's going to take us some time to burn through. Like, we talk just residentially, let's take, condos, because, condos got built at an all-time rate for a period of time. And we've got now however many units are set to complete, let's say this year and next year, which are the byproduct of the pre-sales in, 20 and 21 and 22, right? So those units are coming up and buyers are very uncomfortable with those prices that they agreed to pay, right? Because a lot of those are above today's market values. And there's going to be a certain percentage that either don't complete, can't complete, walk, whatever. There's going to be an amount of inventory there that we have to chew through. And this happened, I remember this in 2009, 10, 11, 12. There was buildings that completed in that time frame, and it took, in some cases, years to chew through it all. Now, it's a little bit related to the developer's financial capacity and what they can afford to sell them for, right? If you pre-sold your whole building at $900 a foot and today's value is $800, you could sell them tomorrow if you drop them to $799, but you might not be able to. Bank might not let you. Right. There's all these things, but there's going to be a bit of inventory to chew through. But beyond that residual inventory that came from those buildings, we don't have a project that's been started. I'm saying a project. Obviously, there's the odd one here and there, but by and large, we do not have projects that have been started in the last 24 to 30 months. So if you all of that time frame of very few housing starts, that means the inventory that we should have in, let's say, 27, 28, 29, where's it going to come from? We don't have anything starting today.
Yeah.
I mean, there's a site in Surrey right now that's trying to get out of the ground, but they need to get to 50% pre-sold before they can get the money from the bank. They're at like maybe 25% pre-sold. Like they're just going to sit there. And my guess would be is that they don't get out of the ground unless, you know, you get the odd developer that's just got all the cash in the world and they say, I'm going no matter what, but that's few and far between. And so we're just continually pushing everything down the road. And then you know what's going to happen is once the market picks up some steam and there's some optimism in the air, guess what? All those guys are now going to jump back in. They're going to be able to get their pre-sales, but it takes 3 years to build a building from your time you start, right? So we're going to have another lag where we probably just lost our camera. That's okay. We're just audio now. We're going to have another spot in the market, much like 2015, 16, where we had gone years without a lot of new starts. And then the market took off. There was huge demand there. And that's when the prices started to take off post financial crisis, right? We corrected in 9, 10, 11, 12, 13 was pretty flat. And, you know, developers weren't too eager to start too many projects.
Yeah.
And then things took off and everyone jumped back in. And then you saw buildings come to completion in 19, 20, 21, 22. And of course, that's years after they've started, but they only started when they saw the optimism again.
Do you see the demand changing? Like I was just talking to a gentleman yesterday who was saying he wants to buy pre-sale condos and is looking like, well, now would be a great time to put money down and buy a pre-sale.
Yeah.
You know, it's 2 to 3 years. This gentleman probably had the ability to buy a unit right now.
Sure. Yeah.
But instead of that, thought that can you speak to that? What you think, like
Totally.
what the opportunity is? Because I hear that quite often where people are like, if I have money, I'm going to buy more pre-sales. And I'm wondering if there's pricing built into that already.
Yeah. So it all depends on the pre-sale. So there's pre-sales available right now where I could show you that in terms of today's market values versus what they apparently have their cheapest prices at in pre-sale, they are 15 to 20% above today's market.
Really?
Oh, it's absurd.
So you're paying for that time.
So, but you get different types of buyers. You get, like, in my opinion, a real buyer who pays real value is a buyer that says, I could complete 30 days from now.
Right.
That's today's value. There's a lot of speculative purchasers, ironically enough, still out there gobbling up some pre-sale right now, way above market value, way above market value. But that's a completely different segment of the market, which we've seen in the last 10 years gets bailed out usually by the constant increase in the market. But there are pre-sales occurring right now that if you took that unit on the market today and needed to sell it in the next 90 days, you would get nowhere close to what you're on the pre-sale contract for. Now, that's some. There are some pre-sales that I've found, they're harder to find, where they are actually trying to pre-sale at today's adjusted values. Now, there's not many developers doing that. They're hard to find because here's the reality. In most cases, you couldn't have afforded to build the building and sell it at those numbers. So you get some buildings that are getting turned into rentals. They're coming off the market entirely. Developers are giving all the deposits back. They're turning them into rental buildings. But there's some sites that I'm aware of where if you look at the numbers, it's like, wow, that is an opportunity because you're actually buying a pre-sale today at today's value, and you're getting the added benefit of only putting your deposit down, and maybe it's slated to complete in 3 or 4 years. There's lots of evidence that this can be timed incredibly well. Like I can think of specific buildings where people put their money into the building in 2014, 15, 16, and they looked like absolute heroes when these things completed in 2020, 21 or whatever, right? But you got to make sure, like when you're buying a pre-sale, what is the value you're signing up for? And of course, when things are hot, nobody asks questions. They all just think, well, it's a pre-sale. It must be a good deal. There's loads of examples of terrible deals on pre-sales that people signed up for. You got to look hard and you can find buildings or complexes or whatever where the number you're on paper for is reflective of today's value. Keeping in mind that today's value is adjusted values, right? Like if we just pick like condos in Abbotsford as an example, because I'm most familiar with that market. Today's value, you'd be hard pressed to argue more than $600 a foot for anything anywhere in Abbotsford right now. Doesn't matter what, I mean, I'm talking wood construction, not concrete. People are buying pre-sales right now at $750 a foot. $750 a foot.
Wow.
And you could go buy a gorgeous 3-year-old condo right now in a, ironically enough, in a building that maybe the same developer built.
Wow.
And you can buy it for $600 a foot, or in some cases even less. So if you can find in Abbotsford, if you can find a pre-sale opportunity at $600 or less, giddy up. Unbelievable opportunity.
Can that cash flow? But at $600, can you get close to cash flow?
Well, now we got to break down, like, are we buying a 1-bed, a 2-bed?
Okay.
You know what I mean? Like it gets a little bit, it's a little bit tougher, but
it definitely won't cash flow at tomorrow's number.
Oh God, no, not even close. Right. No, I mean, and you get into these micro units where it's like, well, it's only a 320 square foot unit. It's basically a hotel room. And that's all the rage now in some of these buildings. Right. And so the smaller the unit, the more they can charge per square foot because it still looks cheap. But what are you going to be able to rent these micro units for? In many markets, this is untested. I know it's not untested in Vancouver or in Coquitlam. Guess what? It's untested in the Eastern Fraser Valley. Yeah. Do I want to own a 340 square foot condo as a rental in Abbotsford or Chilliwack right now? I'm not sure I do. I mean, would you eventually rent it? Yeah, but I kind of feel like it's going to be a lot lower rent than a 600 square foot 1-bed that, by the way, they're everywhere and someone can rent those. So I think, there has been definitely a shift in the let's go Langley, Abbotsford, Chilliwack. You've seen a lot more of this like city type building, right? With smaller units. And I get it. Real estate's expensive. You got to go smaller, but the prices per square foot that we're seeing in some of these pre-sales do not align with today's values. Right. I remember going way back, there was a building, this is in 2008, 2009. At the time, the real market of Abbotsford condos was $200 to $220 a foot. Okay. This is back like 2008-9 era. So 1,000 square foot condo was $200,000, give or take. There was pre-sales done at buildings in that time at $300 a foot, but the market was hot and everybody loved it and nobody questioned it. Well, guess what? That building came to completion years later at $300 a foot. And the real market at that time was still about $200 to $225 a foot. And it took years to absorb all that extra product. And basically what had to happen is the market had to catch up for people to be able to get out. And so we are in a very similar situation here where, could the market take off and catch up to these 750 foot prices? Sure, maybe. But if it doesn't, we're going to have a bunch of people who've signed up for stuff that's not indicative of today's value, and you need the market to bail you out. Yeah. But there are opportunities right now for pre-sales at today's values. And do I think, back to your question, do I think that's a good idea? Sure. I like the idea of getting today's value and paying for it tomorrow.
Absolutely.
But you got to find those opportunities. And most pre-sales that I'm aware of that I've looked at, they are some version of tomorrow's numbers.
Okay.
They're not today's numbers. Because, to our original point, you can't actually build a building and make a profit today at today's values because of the residual land value. Yeah. Nobody went in. Most people did not go into their analysis and go, I'm going to start a building 4 years ago and sell it for $585 a foot.
Right.
Not a chance.
Yeah.
They were selling it for $700 a foot or more. And the tables have churned. So that's why it's hard to find a scenario where a developer is willing to make pre-sales at today's numbers. I don't know how it financially makes sense.
Yeah.
And I know of one in particular where I think he's considering it like as a loss leader. It's a large project that's got multiple phases and he wants the momentum. He's got to keep going. There's hundreds of units, right? So maybe he's willing to sell one building or half a building at these suppressed numbers because he's got boots on the ground. He's already building. He's got it. You're not going to take everyone off the site. You got to keep going.
Yep.
So you go, okay, I'm going to go of these hundreds of units I have in this development. I'm going to sell 50. This one building is going to be at $600 a foot. I'm going to make no money, but I got to keep my machine turning.
Right. It reminds me, and people got away from this when the times were good, but it reminds me that like my job selling commercial real estate is really based on math.
Totally.
Like there's not a lot of emotional connection with these developers. For a developer, the site works mathematically or it doesn't. Another developer might be using slightly different numbers. They might have different assumptions.
Sure.
But gone are the days where no one's doing math. And
Yeah.
for however many years, people didn't do math,
Yeah.
right? Now they're doing math. So if you want to know what a property's worth, start by doing some complex math and understanding how your buyers are doing their math.
Yeah.
Then we actually have a starting point where we can say, and we can have discussions and we can disagree with the developer saying, no, I disagree. Here's why your sales numbers should be this, or the construction.
Yeah.
But begin by having those somewhat complex mathematic conversations, because that's how they're making their choice.
Yeah.
It either works or it doesn't. Same thing with industrial. Someone can either produce more windows and doors or they can't, right? They either need more. It's just a matter of helping them through the math to determine if that's their best alternative. There's not a lot of emotion when buying, not a lot of sentimental value. It's just, can this actually work? And is this a wise decision? So trying to help people walk through those numbers, which it's a lot harder to do that now when you're not getting bailed out by the market. So many choices were made that seemed good at the time. And fair enough. We were on a trend of rocking and rolling. Everything was worth more. And now it's the opposite. So certainly taking time and energy to help people understand what they've got is important right now.
Yeah. That's probably a good place to cap it. Few housekeeping items. So we have office meeting in Surrey in one day. Today's Tuesday. We're recording this Tuesday. So I don't know when this is going to go out. Today's Monday. My days are all messed up. Wednesday, office meeting Surrey. We got some great Royal LePage training coming up the week after. Everyone's been contacted about that. Is there anything else I'm missing? Oh, we have office tours starting back up. That's right. Okay. So everyone just pay attention to your emails and all communication, and we'll figure it all. Thanks for doing this.
Yeah, absolutely.
We have a new sales contest. Yeah. We got sale. Yeah. So we talked about that in the office meeting. We'll talk about it in Surrey tomorrow. That was great. Thank you. We'll do it again.
Thank you.
Okay.
Take
Cheers.
Care.